Most people think that when the Fed cuts rates, mortgage rates come down. But we just got another Fed rate cut this past week, and mortgage rates actually went up again. Let's talk about why that happened, what's going on in the national housing data as we just closed out October, and what it could mean for you and the housing market ahead into 2026. If you don't know me yet, I'm Karl, your San Diego realtor, and this is your San Diego Market Matters national deep dive into the latest market data to see what's really happening in the real estate market. Now, if you like nerding out on real estate data as much as I do, consider hitting the like button and subscribe to my channel. Now, let's get into this. The Federal Reserve, they just cut the Fed funds rate again in October, and Jerome Powell's message afterwards was pretty clear. He doesn't want anyone assuming another rate cut is guaranteed in December.
It's going to ruin everything.
It was cautious, it was dovish. That's what Jerome Powell sounds like. He's very let's wait and see. But the market didn't respond with lower mortgage rates. Instead, those rates ticked up. By the end of October, the 30-year fixed rate landed around 6.28%, with FHA loans around 6% and VA loans just above that. Even jumbo loans held steady around 6.3%. That's slightly higher than before the Fed's announcement, and the exact opposite of what most people expected. And here's why this matters. The Fed's fund rate and mortgage rates are not the same. The Fed controls short-term borrowing costs like credit cards, auto loans, and HELOCs. Mortgage rates follow the 10-year Treasury yield, and that's been stuck in a tug-of-war between like 4 and 4.25 the entire month of October. Every time yields dip below 4, investors pull back, sending them right back up again, which pushes mortgage rates higher as well. Meanwhile, the CME FedWatch tool shows a 63% chance of a rate cut in December. Prior to the meeting, I believe I remember seeing it at 96%, but even if that happens, there's no guarantee mortgage rates will fall. In fact, the last 2 times the Fed cut rates, mortgage rates actually rose in the following weeks. So if you're waiting for the Fed to fix affordability, it's probably not the right move. What's really driving mortgage rates right now isn't the Fed. It's investor confidence, inflation trends, and the global bond market. And despite all the noise, the data we're about to look at shows the housing market is still holding surprisingly steady. So now that we know what's happening with rates, the Fed cut, the slight bump afterwards, and the back and forth with the bond market, the real question is how are buyers reacting to all that's going on? Mortgage applications have continued to trend downward, which isn't unusual for this time of year, but it does tell us something important. Even with rates improving from where they were last year, affordability remains tight enough to keep a lot of would-be buyers still on the sidelines. In other words, slightly lower rates haven't been enough to reignite demand heading into the holidays. Now, when we look at pending home sales, those are the homes that went actually under contract, they're holding steady and almost perfectly in line with the 2024 levels, surprisingly. That's really interesting balance. It means that while fewer people are applying for loans overall, the buyers who are in the market right now, they're serious, they're qualified, and they're moving pretty quickly when they find the right home. Nationwide, there are about 357,000 homes currently in contract, almost identical to last year. And that kind of stability after 2 years of wild swings shows that the market is adjusting rather than collapsing. And that's the key takeaway here. The housing market isn't being driven by panic or euphoria anymore. It's settling into something more balanced.
Did I just sound totally lame?
Buyer activity is slower, but it's steady. Think of it like a marathon instead of a sprint. Buyers are pacing themselves. They're not chasing every new listing, and they're moving forward when the numbers make sense for them. So now that we have an idea of where demand is holding and it's holding steady, let's flip to the other side of the equation. That's supply. National single-family inventory is holding firm. The spread between 2024 and 2025 levels has been narrowing for months now, which tells us that while more homes are on the market than a year ago, the rate of growth is slowing. In other words, inventory isn't climbing like it did earlier this year. It's stabilizing. And the new listing data backs that up. The first few weeks of October looked really similar to 2024, but then something interesting happened. That last week of October, we saw a noticeable spike in new listings, pulling us slightly ahead of last year's numbers. The late month bump suggests that more sellers decided to test the market before the holidays, either hoping to get ahead of the potential price softening or simply trying to move inventory before the slower winter season really hits hard. And here's where it gets really interesting. Even with the uptick in new listings, overall inventory hasn't started rising dramatically. It's holding steady, mainly because of pending sales, just as we talked about. They're keeping pace with what's coming in. In fact, if you add it up, roughly 259,000 new single-family listings hit the market in October, while about 357,000 went under contract. That means that the market absorbed nearly 100,000 more homes than were listed that month.
Where's my calculator?
That's pretty far out for an October. That right there tells you that this isn't an oversupplied market. It's a market that's still finding equilibrium. Now, if you zoom out and compare today's inventory to pre-pandemic levels, the story becomes even clearer. According to Resi Club's latest analysis, most of the US is still operating well below 2019 supply levels, with parts of the Midwest and Northeast down 40 to 60%. The only regions showing growth are the Sun Belt states like Texas and Florida, and a few states in the South where new construction has been especially strong. So when you hear these headlines about rising inventory, that's not the full picture. The national market isn't flooded, it's fractured. Oversupply is concentrated in a handful of fast-building states, while much of the country is still short on homes compared to what was used to be the norm before 2020. The takeaway here that I want you to have is that inventory nationally is steady. It's not swelling. We may see levels even hold into November rather than dropping like they usually do this time of the year. And if that happens, it could help to keep prices fairly stable through the end of the year. Not surging, but not slipping either. Now, as we wrap things up, let's talk about where sellers' heads are versus where buyers' heads are, because the psychology between the two couldn't be more different right now. On the seller side, we're seeing motivation, not panic. About 41.6% of homes nationally have had price reductions, slightly higher than last year, but following the same seasonal pattern. Sellers are realizing that if they want to get their homes sold before the holidays, they can't overreach on price. That's why we're starting to see price cuts taper off earlier than usual. They're adjusting faster, getting realistic sooner, and that's keeping homes moving. On the buy side though, the data tells a different story. The Mortgage Bankers Association Purchase Application Index shows applications trending lower again. Now that's normal for this time of the year. Demand always cools off through the holidays. But what's telling is that even after months of rate improvement, it hasn't sparked a big rebound. Buyers are still cautious. They're watching properties and waiting for the right opportunity to move. So when you look at all of this together, rates, applications, inventory, and pricing, what we're seeing is a housing market that's more balanced than it's been in years. It's not a seller's market, it's not a buyer's market, it's very, very neutral right now. Buyers have options again, but not so much that they can just throw out lowball offers and expect results. Sellers have competition again, but not so much that they have to panic. This is what a normalized market looks like: slower, steadier, and a lot more logical than what we've been through since 2020.
It's about damn time.
Now, how long that balance lasts depends on what happens with rates and inventory over the next few months. If inventory holds steady or maybe starts to trend downward into the new year, it could help soften, or I should say offset, the slower demand that keeps prices stable. But if new listings start to outpace pending sales again, especially in some of those high growth states, we could see some regional softening showing up in the early 2026 year. Either way, this current moment gives both buyers and sellers something they haven't had in a really long time: some freaking breathing room. And that's what's going to make the next few months so interesting to watch.
Well, now you've got my attention.
And that's a wrap for this video. If you enjoyed nerding out with me on this data, be sure to like and subscribe. As always, I'm Karl, your San Diego realtor. I'll see you next video.